So here to discuss those numbers and more, JP Asset Management Global Market Strategist David Lebovitz and Grant Thornton Chief Economist Diane Swonk. Good morning to you both. Diane, I'll start with you because obviously we saw strong additions. We saw the unemployment rate decline, but that labor force participation rate is really still very stubbornly low. We're bouncing along those 1970s lows right now. Why do you think that is?
Exactly. We're still having a hard time bringing in workers off the sidelines. We did see during the month the number of workers who were ill and could not work fell by about 150,000. It had swelled over the summer as the Delta wave sort of took hold, and those numbers are starting to come back. We also know from the Household Pulse survey that many workers who were caring for people who were ill actually dropped during the month of October. So I think we'll start to see that participation come back. But remember, we also are going against a surge in retirements. We had a tsunami of retirements during the pandemic, and it's not clear all of those workers are going to be coming back into the labor force in the months to come. We also know there's long lags when people make the decision to stay home with children, not sure if their kids will go back into quarantine or not. This is where vaccinations for 5 to 11-year-olds really make a difference. That is a longer-term decision and harder to extricate yourself from and get back into the labor force. The good news is we did continue to see a drop in the long-term unemployed, which means we're whittling away at those workers who were laid off first.
Yeah, David, I mean, I'm looking at your notes here, and you expected the economy to add about 500,000 jobs for the month of October. So largely in line with your own expectations. You take that, you couple it with the messaging and the news out of the Fed earlier this week. And of course, we've just had one record high after another for the major averages. The trajectory for stocks and where investors should be putting their money to work at these levels.
So, I mean, obviously, this morning's numbers, they were better than expected, much more consistent with what we've been looking for in terms of the current recovery. I would agree with Diane that, you know, the one proverbial fly in the ointment is what's going on with the participation rate and a couple of other things I would add there. I think, you know, we're also seeing consumers sitting on very elevated cash balances that could well be keeping them on the sidelines. And there's still a bit of a skills mismatch. You know, before the pandemic, about 80% of the jobs in the United States were in services, about 20% were in manufacturing. And given that the services part of the economy is still a bit under pressure, you know, we think that it's one of the things that may be impeding an increase in the participation rate. But, you know, the economy is certainly picking up some momentum clearly after its third quarter lull. And so as we look ahead to next year from an equity market perspective, again, we think that economic growth is going to remain above trend. We think, importantly, nominal growth is going to be quite robust next year, and that paints a pretty constructive picture for corporate profits. We do acknowledge what the Fed is saying. To us, tapering is not tightening, but we do think that long-term interest rates are going to rise. And so given that the primary way that rising rates pressure equity markets is vis-a-vis valuations, we're increasingly focused on that earnings story. And from a sector perspective, that leads us to places like financials, industrials, materials, technology. We really want to own those sectors and industries that have earnings streams that are most levered to the underlying pace of economic activity, because clearly, along with a lot of other economists, we are expecting economic growth to reaccelerate here into the end of 2021 and the beginning of 2022.